Thank you for joining me on another CEO barbecue. My name is Antonio, and today I'm taking you with me to Chile, where I'm going to be looking for copper. Joining me on the barbecue today is Dr. Paul Gow, the CEO of Tribeca Resources, as well as Thomas Schmidt, the company's president and director. Before we get into it, though, I would like to warn you that we have not received monetary compensation for the production of this video from the company that's being interviewed. Please understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research, and you should treat this as an advertisement instead. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, so before continuing on, please talk to an investment advisor with a good long-term track record because your capital is at risk, and I am neither a licensed financial advisor nor do I have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers I just showed you and told you about, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Tribeca is listed as TRBC on the TSX Ventures Exchange, where over the last 3 months, an average of just about 6,000 shares have traded daily. The stock's 52-week high is 49 cents and its 52-week low is 16 cents. With a market cap of just under 20 million Canadian dollars and 66.5 million shares outstanding, today this is a 30-cent stock. There are a little over 1 million options and about 5.5 million warrants outstanding, bringing the number of fully diluted shares to just over 73 million, meaning an increase of about 15% in shares outstanding can be expected if all dilutive securities get exercised, which would then result in about a 12.5% ownership dilution if, and that is always a big if, but if those actually get exercised. Management ownership here is recorded at about 1/3 of the company, or 32% to be specific, with institutional and high net worth individuals assumed at 22%, leaving less than half of the company in retail's hands, which might also explain the low trading volume, but that's hopefully something we'll figure out later on in the conversation. The effective date on the last officially filed interim financial statement is September 30, where the company had recorded about $2 million in current assets, which at the time, most of which was in the form of cash and cash equivalents. On the other side of the September balance sheet, I see no long-term debt and just about $110,000 worth of account payables recorded as current liabilities. Of course, Tribeca recorded about $1.6 million as expenses for the 9-month period that ended on September 30, although that number includes share-based compensation, which is, of course, a non-cash cost. So the total out-of-pocket cost or out-of-pocket expense for the company was recorded at just under $1.4 million. About 60% of that cost, or $800,000, was made up by exploration and evaluation expenditures. That cost was not actual exploration, though. It was not actual drilling, and it was mostly made up by an option payment for the property. G&A sat at just under $600,000 for the same 9-month period, or to be specific, that will be an average of about $63,000 per month. Director and officer compensation made up the largest chunk of that cost, accounting for give or take half of that total spend, whereas marketing came in at about 9% of the total G&A. As always, I've got two ratios for you here. First of all, the exploration to administration ratio, which sat at about 1.4 or 60% in favor of exploration and evaluation, which again, in this case, was just property payment. So it's not fully representative. And then I typically also have the actual drilling to marketing ratio here. But again, there was no drilling happening in the past 9 months. And well, you'll figure out why that was as we keep going through the conversation. And in general, please understand that I'm not infallible, though I may try. So I might be making mistakes in my reading and or interpretation of these numbers. So it is safer for you to head over to setterplus.ca for yourself and make sure you're getting the full picture. Also try and look for the full year report so that you get a more representative overview of the financials. For Tribeca, that full picture is fully focused on exploration and specifically exploring the copper gold IOCG belt in Chile, Chile's coastal belt. Their flagship project is called, and give me some rope here on my Spanish, it's called La Higuera, and it's an early stage exploration asset with historic drilling and geophysical anomalies, but no defined resource yet. There is more work to be done, which is definitely going to be part of the conversation here. They also hold an option on the Chiricuto project, which requiring which requires kind of a milestone based option payment, if you will, and all of which is something we'll try to separate fact from fiction on later on in the conversation. But gentlemen, this is your first time on the barbecue. This is the CEO barbecue. So Dr. Gow, we'll start with you. What's your track record, and why do you think you're the right man for this job?
Oh, well, yeah. Well, firstly, thanks for having us on, and Antonio. And it's the CEO barbecue. I should, I guess, before we start, sort of flag that Thomas and myself. It's all whilst we have different titles, it's almost a co-CEO situation. We have very complementary skills. So to answer your question, yeah, I'm a technical guy, and I've I guess worked in copper most of my career. A lot of that time with the majors, but predominantly working in Australia, Brazil, Papua New Guinea, and a little bit of time in the Philippines, and also other places for much shorter duration. I've Tribeca is focused on IOCG style of mineralization, and that's where I've spent a lot of my career as well. I guess I'm a little different to a lot of the CEOs in that I've throughout my career sort of been in and out of academia to a certain extent, with both university and government research organisations for small stints. So I guess I'm very academically oriented. In terms of more detail about what I've been working in copper, the IOCG, iron oxide, copper, gold, but also porphyry deposits as well. So I've worked the IOCG. The big belt is in South Australia around the Olympic Dam deposit. I did my PhD and then worked out there for a while, and then up in the Cloncurry belt in northern Queensland as well is a renowned IOCG belt, and then I went over to Brazil and worked in the Carajás, which is an amazing one of those mineralized terrains that has so many different world-class deposits of different commodities, and explored there for IOCG deposits. There are a lot of very large deposits there, a lot of them held by Vale, the Brazilian Canadian entity, and we discovered an IOCG deposit there, I think called Esperanza, that we vended into a junior called Avanco, which then went into Oz Minerals, and it's ultimately ended up with BHP, who have that in northern Brazil at the moment. So that's in production. So that's a nice thing to be involved with. And then I've worked in porphyries in a little bit in the Philippines, but predominantly in Papua New Guinea, which was very different. And that was a 2 billion ton copper gold porphyry called Freda River. That was with Xstrata and Glencore. So that was really nice program. Very tough project, but we took it from a 1 billion ton to 2 billion ton resource through a large drilling program and feasibility study. So that's my background. A little bit different to the common CEO, I guess, Antonio. But that's the way it is.
Looking at some of your public history, if you will, there isn't all that much to look at, actually. I think this is your first position in a public company, if I'm not mistaken.
Yeah, this is my first position in a public company, or well, apart from the public majors, of course. Yeah, I guess talking about Thomas Schmidt, we met. We were both working at Xstrata at that stage, Xstrata Copper, and for various reasons, we both ended up at on our own and looking around, and we both had a similar thought to say, well, we've worked for those majors. What about we try something a little more entrepreneurial? On our own, and that was essentially where Tribeca Resources came out. So we said Tom had a very long history working in Chile with Xstrata Copper, and I'd spent a lot of time in South America, predominantly in Brazil. So we said, well, let's go to the IOCG belt in Chile. It was the last of the 4 major belts globally that I hadn't worked in. So that's basically how we put Tribeca together. So that pulls into your comment that I don't have a long track record in the junior space, or neither does Tom. So we're sort of coming from a bit of a major company background. Mm.
I thought it was the paperwork that attracted you guys to running a public company.
Yeah, well, it's interesting you say that, Antonio, because it's and anecdotally, when I worked for the majors, 10, 20 years ago, there was not so much paperwork, but from talking to a lot of the people who are working for the majors now, there's a lot of internal paperwork. That's probably equivalent to what the juniors are doing in terms of being publicly listed, etc.
I saw someone posted on LinkedIn a private placement document from the 80s or the 90s, and it was literally one page, like one side of one page. And when you look at them right now, they're 30 pages long or whatever. They're you need people to actually do that for you if you're as inexperienced as I am. Talking about that, and we will talk about financing later on. Insider ownership is relatively high at almost a third of the company. How much of that is you personally, and more importantly, really, what's the average cost of the shares that you own?
Yeah, look, I guess as you would have seen, is that management ownership is what, 32%, I think thereabouts, and that is pretty much split. 95% of that, or maybe more than that, is split between Thomas and myself. So we both own 16% each. And basically how that's evolved is, I guess, us being the founders, and we talk about cost of that shareholding. Well, I guess it was basically about I hate the term, the sweat equity, but it was about 4 or 5 years of working unpaid, and then on top of that, at the start, to get into our first project in Chile, and to develop that, we put in probably about $500,000 US, I think, Tom, into that. So that basically that time and that funding is where that equity came from.
With the price now down about 25%, give or take, since the highs of last summer, do you expect to be in the open market to support the stock?
Well, I think, Tom, you can answer that. I think you've recently been in there.
I have been in the open market. We'll come to talking about this in a minute, but we're currently drilling. So we're in, for want of a better word, is a closed period now where rigs are returning and we're seeing core at surface at Chiricuto. So we're not able to trade at the moment. But before we started drilling, I did go in the open market and acquire some shares. So, opportunistically we do that. And in addition, we've also supported the company in the last private placement as well, in the financing that we did last summer. So, we do opportunistically look to get into to additional share purchases as and when the opportunity presents itself at what we view as favorable prices relative to what we think the potential is for the company.
And that is something indeed I do hope to get to when we start talking about raising money. That's probably going to be toward the latter part of the conversation. What I'm looking for here, gentlemen, is, and I understand you have sweat in the game, I'm looking for skin in the game as well. How important is, and Paul, we can start with you, but how important is Tribeca to you as an investment? I mean, is it a large part of your portfolio, or in terms of size, how do you see it?
Yeah, it is. It is, Antonio. It is. Yeah, yeah. Without delving into too much detail of my finances, it is a large part of my investments, I guess. So I'm very much aligned, and I don't quite wake up in the middle of the night sweating too much on it, but it is something pretty considerable for me. Mm.
And the same goes for me. And I think a good saying here that I came across many years ago when working with private equity industry is that the private equity guys used to say, when they would incentivize their management teams, that they wanted the position that they had in the company to be significant enough that it was the first thing they they thought about when they woke up in the morning, but not so big that it stopped them from going to sleep at night. And I think Paul and I are both in that position. I can only speak for myself here, but this is significantly more than half of my investment portfolio and net worth. So this is certainly something that is absolutely the first thing we think about when we wake up and throughout the whole day. In my case.
do you guys do other stuff from the perspective of leading other companies in the private sector, or investing your money elsewhere?
No, nothing else. In my case, this is 100% full-time endeavor.
Yeah, likewise. So Tom and I are both 100% involved with Tribeca, and as I mentioned earlier, it's sort of a co-CEO type situation where I very much run the technical type of work, and Tom looks after the corporate and IR and those sorts of things.
Okay, so you don't actually have to do as much paperwork as Tom does.
Yes, yeah, true.
I think it's fair to say that Paul helps out a lot more on my sort of side of the fence than I'm able to on his side of the fence. Obviously, geology is a pretty complex science, and there's unfortunately, as much as I'd love to, there's not that much I can do to assist Paul. Whereas on the other hand, he's able to chip in quite often, and typically does as well. So I'm pretty fortunate in that sense.
Gentlemen, given that you put the initial project together, the initial package together, as far as I understand it, do you or personally or any of the other executives or board members either directly or through a related party own a royalty on any of the projects?
No, we do not. There are royalties across the properties, 1% NSRs, but those are held by the original or prior owners of each of those properties. Neither Paul nor myself nor any other management team or board member or related party has any royalties on any of the properties.
Is that buyable? Can you buy back that royalty or half of that royalty or something like that?
There are a number of different royalties. Some of them have buyback clauses and some of them do not. So it's a bit of a mixed bag.
Right. Okay. Well, that about does it for what I call my smell test with regards to management. And before we get into the actual barbecue, I'll need a smell test of the asset too. So tell me more about La Higuera, starting with its history. Who owned the project before you, or the different parts of it? What historic work has been done on it? And most importantly, why didn't previous operators get it to the point that you hope to get it to?
Yeah, thank you, Antonio. Well, firstly, you made the comment earlier on. I think it was an apology for any potential Spanish mispronunciations, but you've done perfectly. La Higuera and Chiricuto are the two projects. So thanks for that. You're obviously spending a bit of time working with South American or Spanish entities. So La Higuera, we got into that project. I think it was probably about 2017, 2018, maybe. Correct me if I'm wrong there, Tom. But basically, when we got into Chile, we said, well, let's have a look through the IOCG belt, and Chile is relatively tightly held because of the tenure system. So we basically reached out to all of our networks and public information, everything we could find, and we stacked up at that stage. There was probably about 180 or 150 projects, and we looked through all of those to see what we thought was something that we should be looking to get into. We'd been looking for a little while, and we'd sort of come against that catch-22 situation where it's hard to get a project without the funding, and it's hard to get the funding without a project. Yes, I'll use the word significant project with significant funding. So we basically said, well, to get out of this catch-22 situation, let's put some of our own money in there and just acquire a project that we think is valuable. And what we were looking for were projects that had some type of exploration activity had happened on them, because it's very tough as a junior to be going into absolute greenfield projects that don't have work on them. It's high enough risk already. So we were looking for projects that had some work done, preferably some drilling showing that there was a mineralized system there, but that for one reason or another had been overlooked, and there was potential we thought that hadn't been addressed. And that potential cannot be addressed for a variety of reasons. Can be the culture of the explorer, or indeed the culture of the time, which certainly back in Chile, the La Higuera project, the work was back in the 2000s. And to a certain extent, people weren't exploring so much undercover. So that we saw that as a new, I guess, sort of search space, because people in Chile up until that time, people had been working undercover, but there was very much a strong focus on outcropping rocks. And so we came into the La Higuera project, and we looked at the data. We saw that there was some drilling that had some reasonable copper intersections in it and showed there was a copper system. but there was also some geophysical data that when we sat down and integrated the data all together, we thought, oh, this thing, look, it keeps going north under the gravel cover. So that's why we thought this thing hadn't been appreciated. So that was exactly what we were looking for, something with some work showing there was a copper mineralized system there, and that additional data showing that this thing had blue sky and some size to it. So that's essentially why we got into that project. So the previous work had been sort of back in the 2000s, 2006 and 7 predominantly. So it was sort of a hiatus of 12 years before we came back to that project.
Is the idea, and we'll definitely get into some of the details that you walked me through there, Paul, by the way, later on. But as far as I understand it, La Higuera is your only asset right now. Well, you have the option of with the Churicoto, but it's not exactly it's not exactly a separate asset the way I would think about it, as in from the risk perspective. What I'm really trying to ask here is whether you have plans to change that, or whether you want to come up with ways to manage kind of the one, let's not call it one asset because that's not entirely fair, but the one company, the one country company risk, if you will.
Yeah, maybe I can answer. Maybe I can answer that.
I was about to say, Tom, you might be able to explain this.
Sure. Yeah. So I think the short answer to that, and then I'll give the longer one. The short answer is that since we listed 25 months ago, we've set out a very clear strategy that we want to take a portfolio approach to exploration, and we want to focus on the coastal belt in Chile, although that belt does stretch into southern Peru as well. And we think of it, even though the Chiricuto project is owned through a purchase option, we do think of it as two assets. They're very geographically distinct from each other, and they're very different projects, albeit both IOCG projects with copper gold as the primary exploration targets there. So it is very much about taking a portfolio approach, and we think there are. And now I'm getting into the detail here, but we think there are a number of reasons why you would do that. We understand why some retail investors don't want to see multiple projects sitting in a junior company. They prefer the kind of all or nothing approach of a lot of junior companies with single projects. But we do think that with the cost, and we've talked about this, and we'll touch on it again. But the cost of being public, which in our case is about $800,000 a year, we do see some value to being able to spread that effectively fixed cost across multiple projects from a capital efficiency point of view. But more importantly than that, we think the ability to dynamically allocate capital, that is to say, each time you make a spending decision, you could be evaluating between multiple projects that you already own. Where am I going to get the best bang for my buck with the next dollar I spend? Now, single asset companies don't have that luxury. By having a portfolio, and we think we can manage probably sensibly between 3 and 5 projects. We currently have 2. By having that portfolio, you can constantly be thinking about where do my shareholders get the best return for the next dollar. And that can change over time, right? That can change depending on market conditions. It can change depending on progress that you've made with the projects. It can change depending on commodity prices. When I said market conditions, I mean equity markets. Those two are obviously intricately linked. But so we think there's a lot of value to taking a portfolio approach. And that's something that we're going to stick to. And then in terms of how we manage the portfolio and where we take the company from here, we are looking at business development opportunities. As I said, 3 to 5 is sort of what we think we can manage, sensibly in terms of total projects within a junior company of our size. We are looking at business development opportunities both at those 2 projects, at La Higuera and at Chiricuto. There are opportunities to add neighboring ground. And then outside of those 2 projects in the broader coastal belt and within Chile, we're also looking at opportunities. The focus is on IOCG type prospects. But if we see a great opportunity that's not an IOCG, but that we still think we can add value to, then we would consider that as well. So I think the message here is part of where that all came from is we've seen time and time again junior companies that, go in, grab a project, go to test the theory, and, get a sort of neutral or negative answer, and possibly should be dropping that project. If they were sitting within a portfolio within a major company, it's the sort of project that might get dropped. But because you have a management team that are entrenched and, able to raise some money and draw salary, projects don't get dropped. And we think that by having that portfolio of projects, it should make it easier for management to to not have the fear of walking away from a project. So not only, you're getting into new projects and upgrading the portfolio, hopefully with success, but you also have the ability to drop projects as and when you get results that, don't come back the way you expected them.
The drill to kill approach is, if you will, that you're describing here, something that I hope we can talk about. But I'm glad we're talking business strategy here, because this is a good point for you to explain the business case for La Higuera or Chiricuto to me. What is it that you want to do with them? What work do you want to do with them? What is that going to result in? And how long do you think it's going to need? How long do you think it's going to take for you to make me money if I bought the stock today?
If I can start with the end point of that, and then I'll let Paul kind of get into a bit more of the detail. I mean, the end game here is to define mineral resources that ultimately we think are going to be of interest to an audience. And the audience we have in mind are the large and mid-cap producers. So we're not trying to find the next Escondida for BHP or the next Collahuasi for Glencore or Anglo. What we're trying to do is find the next Candelaria or the next El Espino for a Lundin, a Hudbay, a Capstone, a First Quantum, or a Pucobre. Those guys have been sitting on their hands in many ways, with a few exceptions, for the best part of a decade now in terms of growth initiatives. Obviously, there have been some exceptions to that with some M&A. There's not been much exploration. So we think at some point, the shareholders that put shackles on those companies back in 2012 onwards, in terms of, operating efficiencies and discipline and capital returns, those same shareholders, it may not be the same individuals, but, those same institutions are going to turn around and ask these companies, well, where's your growth pipeline? And, in many cases, they don't have one. So they're going to have to go out and up their exploration budgets and go out and acquire growth externally. And we want to be ready at that point, ideally with a portfolio of projects that are going to be of interest to those producers. And so that's really kind of what we're trying to do. And what we say is, Paul's talked about this, we want to get into something that's not greenfield, where there is evidence of a mineralized system, and we then want to move it through to maiden inferred resources, because we think that's the steepest part of the Lassonde curve, and as importantly, it's what's best suited to Paul's experience and skill set, where we can add most value. I think what we say is that we would go as far as a PEA, but we don't want to get any further kind of along the timeline than that.
Well, talk to me about timeline from the perspective of how many years you expect that to take, but also from the perspective of how much money that could take. I mean, a porphyry, we're not talking about porphyries here, but just as an example, and it's a stat that I recently learned, although I'm not exactly sure how accurate it is, but apparently takes on average 160 holes to actually get a porphyry going. And that's on average. A lot of the large systems that we know have taken way more than that. So how much work is it going to take you, and how much money is that work going to cost you?
Yeah, it's certainly a deposit specific type of number there. And porphyries, well, it depends on whether you're delineating, 400 million tons or 2 billion tons. But that 160 holes sounds about right for a very large deposit. And so in terms of the time frame, I guess there are essentially two key points to that. And one, probably the most important, is the what the market's doing, and we can talk about it later. The financing, okay. So your financing timetable and how that fits in with what the market's doing is probably the most important point in terms of how quickly you can move. The second point is the results that you're getting. Because if you have the funding and you're getting good results, you can move very quickly if you have those 2 points, good results and funding, and they're often correlated, obviously, but you can you really need them both. So we've been listed now. So just to give you an example of timeframes and costs, etc., we've been listed now for about 24 plus 3, about 27 months, and we're just in the middle of our third drill program. Not enormous programs, but they were on the order of anywhere between sort of 1,500 and 3,000 meter drilling programs. I was just actually today, because we're in the middle of a drill program, putting our costs together for our last couple of programs. And it's one question we always get is, what's it cost to be drilling? And that varies dramatically. So where we are, it's very infrastructure rich and easy access. So our drill costs per meter, all in, have been between about $260 and $310. That's US per meter. So, for example, we're doing a 1,500 meter drill program at the moment, so that's going to be about $470,000. So that's sort of what the costs are. So our previous drill program was just over $1 million, and our first one a couple of years ago was 700,000. And you did say earlier on about the finances and the expenditure for the first 9 months of 2024. So I'm not sure what happened there, but we were drilling in January and February. So there was a component of that exploration expenditure that was drilling, but maybe something's happened along the lines there. So that's sort of the time frame. So our next step at La Higuera, we've done 2 phases of drilling there, and we've essentially defined this system now. So we know it extends over 1.4 kilometres that we've drilled it to date. And then we've just now, in our second program, we collected a lot of data to try and understand where the high grades and what was controlling the high grades. So our next drilling program that we're hoping to get into later this year, in the second half of this year, would be drilling to get some higher grades and to firm up the geometry of that La Higuera, or hopefully the mineral resource. So after that, then we would still be looking to go on to the mineral resource on the next phase of drilling after that. So I guess that's looking at probably about 5,000 meters of drilling, and then maybe another 5,000 to get a significant resource on top of that. It's very much thumbsuck numbers.
And that would take you. And this is very forward-looking and assumptuous too, because we're assuming that you're going to find what you're looking for this season. But on top of that, it's going to take you 2 more seasons on the back of this if this one is successful.
Yeah, well, but we shouldn't use the word season. Drilling season where we're working, it's quite amazing. La Higuera is at 400 meters altitude. Down near the coast, so that once we're getting results and funding, then we can drill relatively quickly there. We're not restricted to funding. So whilst we're on our third drill program now in sort of just over the 2 years, we'd hope to continue rolling at La Higuera. So we're drilling at Chiricuto project at the moment. And we have funding for that. We don't have funding yet to go back into La Higuera, which we'd like to do later this year.
And that is something we'll again hopefully talk about toward the latter part of the conversation. As far as I'm assuming here, so correct me if I'm wrong, but I'm assuming you would need higher grades than what you've drilled so far in order to kind of prove to you that you're on the right path. Where on the property do you go looking for those higher grades, and why?
Yeah, look, in terms of grade, it's very interesting, and why we got into the IOCG belt in Chile as opposed to up into the big porphyry belt, which is much more at altitude, is that there's a big thing called the Atacama Fault System that runs for sort of 1,400 kilometers up through Chile and into southern Peru, and it sort of sits inboard of the coast as little as where we are is sort of 10 kilometers from the coast. And so when you look at the cross section section, you come from the Pacific Ocean, you go over the coastal Cordillera, the coastal mountain range, then you get into this big valley, and then you start going up into the high Andes. And that big valley is filled with gravels, and it's a nice flat area. So when you go into northern Chile and you drive, the main highway runs up that valley, and all the main power lines run up that valley, and the significant infrastructure. So that's why we're there in that valley in the coastal belt, is because you can access it all year round, and the exploration is relatively inexpensive. You know, if we're looking at sort of $250 to $300 US per meter for diamond drilling, and as opposed to up in the Andes, it's, you know, I won't quote the numbers I hear, but you can you'll know that they're significantly higher. Yep. So that's why we're working in that belt. And so it's the operating costs when you're exploring, but it's also the capital expenditure if you do go to build a project, so that there's a lot of the infrastructure already there. And so if you look at the grades of the deposits that sit in that coastal Cordillera, there are some porphyry deposits. For example, the Glencore, what's the name of the deposit up there, Tom, out the back of Antofagasta? And it's about 0.25 copper, I think, on the way out to Calama.
Yeah.
Lomas Bias, and then you look at what's considered a high grade IOCG deposit in this belt is essentially Candelaria, which is 0.55 to 0.6 copper plus gold. So in terms of grade, we've been drilling thicknesses of sort of between about 0.2 to 0.66. So there's not really high grades needed, but what we need to find is the continuity. And you asked about the I don't want to get too technical, but you asked about how do we find those high grade zones. Our first drilling program, we did not. When you're drilling, there are tools that can tell you what the orientation of that drill hole is, so that if you have a copper vein in it, you can tell what the orientation of the copper vein is. We didn't do that in our first drilling program. The second we did, and we put a whole bunch of data together that's now starting to show us the orientation of those copper veins and what's controlling them. So that's what we're hoping to target in the next drilling round.
I do want you to get technical. Actually, I'm hoping you will, because the AFS, so the Atacama fault system that you're mentioning here, is interesting to me, especially in the combination with the locals place, because mostly because I'm thinking, how do you differentiate? How do you distinguish between structurally controlled remobilization of iron ore oxides versus a real, if that's a thing, a real primary IOCG mineralizing event in and of itself?
Yeah, well, I will get a little bit technical. It's very, very complex, and it's been particularly well, I guess, figured out, if I can use that phrase, in Chile, because if you look at the big iron oxide copper gold belts in the world, there's the Gawler Craton with Olympic Dam and many other deposits in South Australia. There's the Cloncurry belt, there's the Carajás in Brazil, and there's the iron oxide coastal belt in Chile. Now, all of those other three belts in Brazil and two in Australia are all very old. Proterozoic or Archean is the technical term for it. Sort of 1.6 to greater than 2 billion years of age. But the coastal belt in Chile is very different, because it's only 115 million years old, and so it's relatively clean and pristine. And so that you can really understand all of the geology that's happening, because it hasn't been deformed and smashed over billions of years. But so what's come out of Chile is people classify these iron oxide related deposits, and they use some acronyms. IOA is iron oxide apatite, which is just iron oxide without copper and gold, and then IOCG is iron oxide with the copper and gold. And they're basically considered to be part of the one system. It's just that the IOA is deeper and hotter temperature, and the copper doesn't precipitate, and the IOCG is higher and cooler temperature and shallower, so that the copper and gold drop out with the iron oxide. So it's they're all sort of part of the one system, and it's very difficult to try and differentiate between the two, particularly when you're undercover, as we're exploring for. And when you're undercover, you can't see the geology, so we're very much relying on geophysical data sets. And obviously, with so much iron oxide in these deposits, that can be magnetite, which is highly magnetic, and magnetic data is very inexpensive to collect and very diagnostic. But some of the deposits like Monteverde, which is over 1 billion tonnes and up near our Chilicuto project, has its iron oxide. Hematite, which is not magnetic. So you need to look at different ways to find that using gravity techniques, for example, and a technique that you no doubt would have heard about from people that you talk with is IP, induced polarization, which is very commonly used for porphyry deposits, but it has issues as well in that you will get a fantastic induced polarization response or anomaly from pyrite, but it may not have copper with it, but you'll also get a great response from pyrite and chalcopyrite copper. So there's a whole bunch of different geophysical techniques that you can use, but none of them by themselves are particularly diagnostic. So what we tend to use is magnetic, gravity, IP, and our last survey up at Chilicuto, we also used MT, which is magnetotellurics. Okay, so IP tends to find speckled, disseminated sulfides, whereas MT tries to find more concentrated sulfides, and it's becoming a much more common technology in Chile. So that's the approach we've been taking, is a very strong geophysical approach, and a lot of that's come from particularly my work in Australia, and it's when you get to the Americas, in Chile, for example, and in Canada, the geologists are well renowned for being fantastic on the ground with their boots and mapping outcrops, etc. But in Australia, there's a lot more cover. So in Australia, the geoscientists tend to be maybe a little more versed and practiced with geophysical exploration and geochemical exploration to a certain extent. So we're trying to take those learnings that I've had from Australia across to Chile and apply them in those covered belts up through northern Chile. So it's a fascinating place to be here. Yeah.
I recently did a deep dive on geophysical surveys with a geologist friend of mine, talking exactly about these things and how sometimes IP can mislead you, and especially how companies use it can also be misleading on one end as well. Paul, the presence of apatite, titanite, and alunite it suggests that you're dealing with a high phosphorus mineralization event in the first place, which is I'm not a geologist, but I haven't seen it too often within the economic copper deposits that they're typically talked about. What's your understanding of how the phosphorus distribution has impacted copper within this system?
Yeah, it's interesting that you bring that up, and you specifically mention apatite. And apatite is a very strong phosphorus mineral. And at our La Higuera project, there's actually one significant magnetic anomaly on there that actually has some old phosphorite or phosphate mines on top of it. So they're mining the apatite. But that zone where we're finding that very intense apatite is it's called Don Bausha. So Tom, you'll know it. And we haven't seen so much copper there, so that the apatite in that case, where it's being very common and well developed, doesn't seem to have quite so much copper with it. And so that IOA, iron oxide apatite type of deposit, and a great example of that is a thing called Kiruna up in northern Sweden, which is actually an underground iron ore mine. So the apatite is very commonly with the magnetite and not so much copper, for example. Although having said Olympic Dam in Australia has a lot of apatite, and you mentioned alunite. Alunite actually has a lot of rare earths as well. And that's one thing that you don't see so much in Chile. You see a lot of rare earths in the iron oxide copper gold deposits in Australia. And Olympic Dam, for example, is very high rare earths. It currently goes to the tailings there, and I understand they're looking at ways to recover the rare earths. But in Chile, we don't see that. So in answer to your question about phosphorus and how it impacts, it seems to be maybe more prevalent in the copper poor. Well, I hate to generalize, but in Chile, in the copper poor iron oxide apatite deposits, yeah. On talking, so talking about byproducts as well. So this is the fascinating thing about iron oxide copper gold deposit, and I can take the whole 2 hours if you like, Antonio, and keep talking about this. But the fascinating thing is that the iron oxide copper gold deposits in South Australia, for example, produce copper, gold, silver, uranium, and rare earths. Okay, and Olympic Dam is actually the largest gold. I think the largest gold resource globally, and the largest uranium resource globally as well, all in the one copper mine. But in Chile, the byproducts are essentially cobalt and magnetite, and so you don't see the rare earths and the uranium in Chile, but instead you see cobalt and magnetite with the copper and gold. So they're sort of fascinating deposits, and we're very much focused on the copper and gold in the IOCG deposits. But I can see as time progresses and people get better at processing ores, and it's going to be a natural way that the world's going to evolve. You're much more sustainable to get 4 metals out of one mine than just to get 2, and so it's going to move that way towards producing copper, gold, iron, and cobalt in the Chilean deposit. So it's fascinating, the processing.
Well, I'm glad you're bringing up magnetite, because as far as I understand it, your working thesis right now is that this is a magnetite dominant IOCG, and as far as I understand it, IOCGs are basically split in 2 groups. So, magnetite, and then you have hematite dominant IOCGs too. And Tom, you said you'd be looking for a Candelaria type of deposit from the business development perspective. What about from the geological perspective, though, Paul? What are comps that you're working with? What are famous magnetite dominant IOCGs, and what do they look like?
Yeah, well, it's interesting, and you're right. There are the magnetite dominated deposits and the hematite dominated deposits, and the famous magnetite deposits, I guess, are Candelaria in Chile. There's another thing called Santo Domingo, which is a magnetite iron oxide copper gold deposit in northern Chile, held by Capstone Copper. There's another one called Ernest Henry in the Cloncurry district in Australia, which was held by Mount Isa Mines, Xstrata, Glencore, but it's now with a company called Evolution, and they're actually mining it for gold. Well, they're a gold company, but so they're very much interested in gold. So they're the magnetite deposits. But Chile is interesting because it has a real mix. Okay, so it has things like La Higuera that we're drilling that seems to be magnetite dominated. It has Candelaria, which I think is magnetite dominated. But then as you head further north, you get up to Manto Verde, which is another billion-ton IOCG deposit, and it's hematite dominated. So so they're very complex, and I'm almost starting to feel like in Chile, and this is just my gut feeling, is that you're moving as you go further north in Chile, you're actually moving from magnetite dominated systems to hematite dominated systems. And the way, without being too technical, the way it typically works is you have magnetite of the deeper systems, and the hematite is the shallower systems. So that maybe as we're going north in Chile, we're seeing the hematite systems that are more shallow, that are now exposed up to the north there. So it's and that has implications for how you explore, obviously. It's very easy to go out and find magnetite dominated systems and using ground magnetic or airborne magnetic data and drill them. You may not necessarily get the copper because the copper's often not throughout the whole system. But the hematite dominated systems are much more difficult to explore for because they don't have that ring like a bell magnetic signature.
Yeah. You said you could talk about these things for hours, and I could probably keep coming up with questions for hours, but I've been way out of my depth for a while now. Let's maybe talk more about the drilling that you're doing right now. Is that, it's 1,500 meters? That's not a large program. Is that sufficient drilling, or is this mostly budget constrained? Like, what would you want to drill more in this first pass, and would this be sufficient to answer your unanswered questions, if you will?
Yeah, look, the way it works, so we're drilling at a project up in northern Chile called Chiricuto at the moment, and it basically sits in what's a fascinating new evolving district with Capstone Copper. So they have their Manto Verde billion-ton deposit. They have their Santo Domingo that they're mining, and they've just gone into the sulfide now, expanding that. And then they have their Santo Domingo project, which is a copper gold iron mine. And the Chiricuto project sits right smack bang in the middle of those. They're about 15 or 20 kilometres either side to those big deposits. So what happened? We were drilling at the start of 2024 at our La Higuera project, and we basically got to the end of that drill program, and we said, look, we need to sit and have a good look at this data and understand what's controlling the high grades. And at the same time, we were getting into the Chiracuto project, which was actually brought to us by a geophysical consultant who we were using. And he sort of, I guess, like the way that we were working and what we're exploring for, etc. So he said, well, have a look at this project. And we had a look at it, and it's essentially one of the last magnetic anomalies in that Capstone copper district that hasn't been drill tested yet. So we said, well, while we're putting La Higuera together, let's go up to Chiricuto and drill test up there. And so we went and did a lot of geophysical work. We did some IP and magnetotellurics work over the top, and partly to our surprise, we found that that's electrical geophysics anomalies did not sit slap bang over the magnetic target that we'd been focused on, so that we're now drilling two separate targets up there. One is the large magnetic system that we'd been focusing on, but another is this large electrical geophysics anomaly that sits off the side of that. So we're drilling these two targets. And to answer your question about drill meters, there at Chiracuto, it's not really budget constrained in terms of what we'd be drilling. So even if we had a larger budget, we probably wouldn't be drilling more than that 1,500 meters. It's just sort of a logical progression with two targets, and the geometry of them, really sort of 5 holes should be sufficient for a first pass to get a feel for those targets. They're relatively simple, so we're hoping that that drilling will give us clear answers as to whether or not they are strongly mineralized.
But this is still within the concept of drill to kill, which is kind of your corporate strategy partly as well, as far as I understand it. But you are, and this is just to confirm, are you ready to walk away if you don't see what you're hoping for?
If we don't see indications there, we would probably walk away from that set of licenses, those properties. It's a nice foothold in that district, and we think it's an emerging district, and we would like to expand our holdings in that district. But if the holes don't come back with anything on these targets, then it is the case that we would step back, walk away, whatever you'd want to call it. And it's interesting, the drill to kill analogy is that I once was listening to someone talk. I can't remember who it was, and they were saying that really the way exploration should work is you should not be drilling to prove your thesis. You should be drilling to disprove your thesis. And that's sort of what we're doing, is we're saying, well, this is our thesis, is this, we've got these styles of mineralization and these are the geophysical anomalies showing them. Let's disprove that's right, that's not the case. So hopefully we're going to prove it's right, but you can't go drilling just to try and prove yourself wrong. I mean, right all the time. It's a philosophy, I guess.
What would that look like, though? Like, what's dead in this context? Or let's maybe turn it around, make it a bit more positive. What's the threshold? What's sufficient grade and thickness, or what is sufficient geophysical fingerprint that you want to see here that would warrant a second drill program at La Chiricuto, or Chiricuto without the La?
Yes, yeah, Chiricuto. Well, probably the last thing you want to hear me say is I can't put a finger or a number on that. But I will sort of try to. What we'd be liking to see is at least sort of very thickness, very large thicknesses. 100 meters plus of at least 0.1 copper to show that you're in a mineralized system. Because for example, we have this electrical geophysical anomaly that's 1.2 kilometers long, and we're drilling 2 holes into it. So it's Olympic Dam, which is 9 billion tons. It wasn't until hole 16 that they got economic grade into that. So we're aware of that. And exploration, I hate to sort of dodge the question and not put a number on it, but exploration is difficult. And someone once said to me, it was a couple of years ago, we were putting out a news release, and the question to me was, well, are those grades economic? And I said, well, this hole, no. And they said, well, why are you putting that out then? And the case is that in exploration, you can have intersections that are sub-economic, but they're incredibly important in that they're showing you the right indicators. So it would be nice to be getting 100 meters at sort of above 0.1 copper to show us that there's a good mineralized system there. But we'll see.
Yeah. Well, what happens if it isn't there, though? And I understand this is again more of a negative corner of the hypothetical realm here, but hope for the best, prepare for the worst, I guess. So, what if this target doesn't show what you hope it would show you from a pathfinder perspective or grade or thickness perspective? Where does that leave Tribeca, and where do you go next?
Yeah, well, look, we are hanging out to get back to La Higuera. We looked at Chiracuto and said, "Oh, look, we can quickly get this done, and test it and understand if there's anything decent there, and then we want to get back to La Higuera. So if Chiracuto does fall over, which we obviously hope it doesn't, the La Higuera, both the Gabby system that we've been drilling and the other targets that we've worked up down there are going to be our next port of call, unless there's any other business development that comes in ahead of them.
Yeah. When is the 1,500 meters going to be done by? You're drilling 300-meter deep hole, so I don't assume it takes too long. But when is it going to be done by?
Yeah, it's going to be approximately about a 60-day drilling program, and we started a couple of weeks ago. So end of March probably we'll be or thereabouts. We'll be wrapping that up. Assays. We submit the assays, etc. And turnaround times are incredibly variable in Chile at the labs at the moment, from anywhere from sort of 2 weeks to 6 weeks. Obviously we'll be finished the drilling then, but it may be a little bit while before, if there's any results coming out as we bring them in. But so that's what we're looking at to finish that by March, and then ideally we'd love to go straight back down to La Higuera, but there's funding requirements obviously.
So you're thinking, let's call it mid-May is when you're going to have the assays, all of the assays out. How are you going to be announcing? Is it all the holes in one news release, partly? What are you thinking?
Yeah, we've typically in the past sort of released a couple of holes at a time, purely just so that we're not, people aren't just sitting there waiting for months on end to get some information. So, but we'll see how that all plays out. So we don't want to be putting out every single hole, but and saturating the market or boring the market. Well, hopefully not boring, because the numbers will be high, I hope. So we'll hope to put them out sort of in a regular manner.
And you started drilling the beginning February 6th, I believe that news release was.
Yes, yeah, that's probably about right. A couple of weeks. Well, that's about 19 days ago now, I think.
So almost 3 weeks. How's that going? How's the drilling been?
Oh, it's good. It's good. I obviously can't say too much about what we're encountering, because we need to release that publicly. But the drilling's going good. We're using a company. I guess use. They probably wouldn't like me to say it, but second tier drilling companies. The major drilling companies, when you put out a drill tender, there's an incredible difference in cost, and so juniors tend to use the second tier drilling companies in Chile, which there are a lot of them there. So we're using one of them, and they're sort of plugging away. We're diamond drilling. In the early days at La Higuera, because a lot of our work is through gravels. So in the early days at La Higuera, we tried doing reverse circulation through the gravels into the weathered zone, and then changing over to diamond. But as it turned out, in terms of time, that was actually slower than just diamond coring through the gravels, and not a whole lot of difference in terms of cost. So so we're diamond drilling, and it's always nice to get some diamond core when you're first into a new project, to try and understand the details of it, which is obviously a lot harder to do if you're using chips from an RC hole. Yeah.
What's the permitting situation, and also basically governments, and I assume you did get the permits, otherwise you wouldn't be drilling, but what's governments and locals up there? Everybody happy with you being there and drilling?
Yeah, well, Chile is Chile is absolutely sensational in our experience in terms of permitting. So at La Higuera, for example, down there, we had three property owners. There were no indigenous groups as such down there, but we had three surface right owners that we had to negotiate with, and that was all pretty good. Where we're drilling at Chiracuto, it is actually state land. So there's no requirement to negotiate with surface owners. And the way it works in Chile is you deal with a group called CERNAGIMIN, which is essentially the National Geological Survey for all extents and purposes. And the way it works, if you're drilling less than 40 platforms, you submit your documents to those guys, and you're pretty much, unless there's some extenuating circumstances, you're pretty much ready to go in about three weeks or 15 working days. So, where we're working at Chiracuto, it's an absolute dream. So it's, essentially 3 weeks permitting, as long as it's a relatively simple situation.
What's the water situation at Chiricoto, and how does that differentiate from what you're getting at La Higuera?
Yeah, the water situation. I guess I'll touch on the exploration water, and then Tom can talk about how to tackle it if you go into production, for example. But in terms of exploration, it still tends to run on groundwater, so that you're drilling. Water trucks go and fill up at the local bores for your drilling, or you reuse the water that's coming out of any of the holes. In terms of water, it's often the question we get asked in Chile. And Tom, did you sort of want to comment on the common solutions for water for mining operations in Chile?
Yeah, sure. I mean, historically, people have access to aquifers and streams and rivers for water for large industrial processes, including a lot of the mining operations and the concentrators there. It's pretty much a given, although it's not necessarily written down anywhere, but it's pretty much a given that any new mine that's going to be built in Chile is not going to be using those same sources of water, which leaves you with a couple of alternatives. The main one being ocean water, and that can be either desalinated or untreated, and that's purely a trade-off decision based on the kind of metallurgical recoveries you get with one or the other. And that's really the main solution. And not only is that what new mines are going to be built with, existing mines are actually starting to bring in desalination, partly driven by ESG, and partly driven by the availability of water from some of those historical sources, aquifers, getting depleted, etc. And then the second of the two kind of future-facing solutions, if you like, ocean water being the first. The second one would be, this is really the holy grail, at least from an ESG perspective, would be treated wastewater from a local town. And in the case of La Higuera, and potentially also in the case of Copiapó as well, we're close enough to a large town. And at the moment, in the case of La Higuera, which is about 40 kilometers north of the town of La Serena, which is hundreds of thousands of people, there is currently treated wastewater being just put back in the ocean there. So that would be the sort of thing that it might not be us, but a future operator of a mine based around the La Higuera concessions that we hold today, or the resources to be defined there, would look at bringing treated wastewater from La Serena as their main source of water, and then trade that off against bringing ocean water from 10 kilometers away from coast from La Higuera.
It's a very interesting situation. It's a very interesting topic for me to talk about, because I think up until like maybe a year ago, I would just completely ignore the issue of water, not knowingly so. I just not think about it. It's just I look at these things, and I used to look at them maybe as tickers on my screen, right? Ticker symbols on a screen, but you don't think about it actually being, potentially having influence on people's livelihoods, or lives, if you will, in a way that you don't necessarily understand by just sitting at a desktop. So I'm glad you're kind of walking me through it. Come time for you to raise capital again, though, and Tom, I suppose this is your part here. How do you do it? Where do you go looking for it? And do you have a preferred mix between institutional and retail investors?
Yeah, I mean, absolutely. I mean, I guess to date we've taken, I guess, a bit of a sort of organic approach in terms of in terms of accessing capital. Obviously, Paul mentioned at the top there that we, put in the initial 500,000 US of capital ourselves when we were private. We then merged with a shell company that came with about $600,000 of cash. In connection with that merger, we raised 2.6 million Canadian, and we did that from our own networks. And we've then done two financings since the listing, 3.3 million Canadian in 2023, and then 1.3 million last year. And in each instance, we've really used our networks. We haven't done a brokered financing per se. We have had some help from a couple of brokers, one in London and one in Toronto, who've brought some investors in on a finder's fee basis. But to date, we haven't done a formal fully brokered financing. And where that's left us is with a incredibly supportive shareholder base. So we talked about management collectively owning just under a third of the company. We also have three London-based, I guess, money managers, broadly defined, each of them in a personal capacity / family office capacity, who collectively own 22% of the company, and they've been very supportive, backing us through all of those financings. So so we get from them, to date, and fingers crossed that continues. The support of a lead order whenever we put a financing together, which is as you know, incredibly helpful. And they also bring some credibility in terms of their background, both in investing in other junior companies that have been having success, and also in terms of their professional backgrounds, in terms of what they do for a living, investing in the mining sector in the large cap space, and then coming into the small cap space in a PA capacity. So that's been really helpful, and I think we'll continue with that approach for as long as we can. And what we've also done is as I mentioned, go through our personal network. So former colleagues, investment bankers that we've worked with over the years, and people who are executives at various junior mining companies, because they know us, or in some cases know someone that knows us, have come in and backed us. They like what we're doing. Paul mentioned earlier the Pedra Branca deposit that he discovered in Brazil when we were with Xstrata. He and I together worked to sell that to an Australian junior called Avanco Resources, and some of the team members from Avanco have followed us over the years, and so people like that have come in as shareholders and supported us. And what we've also done, even though we've not done any brokered financings, is we've made a pretty conscious effort to get to know all the Canadian brokers. So we feel like we've got a pretty good idea. Not only do we have a good idea of who we might want to work with, but they've also got a pretty good idea about who we are and what we're trying to do, such that when the time comes to broaden it out and try to bring in, to the extent that it's available, bring in some retail or bring in some further high net worths in future financings, we know where to go and can move relatively quickly on that front. We're learning as we go. I mentioned, I guess, the 4 financings, if you include the private money that Paul and I put in. Only one of those 4 included warrants, and the last round we did not include warrants, and the reason for that was we had a lot of support from existing shareholders who were happy for us to do, I guess, what would be considered a non-traditional financing in Canada, given that it did not include warrants. But we did find that a combination of no warrants and the market kind of peaking at when copper went to 550 there in May 24 with the short squeeze, that we sort of came out the other side of that trying to close financing. It was a lot of hard work. So we'll have to look at that again. And I think any Canadian broker you work with is going to balk at a junior that's trying to push through a financing with no warrants, because it makes their job difficult, infinitely more difficult. So we have to have an open mind, and it's going to depend on market conditions. And we think we've got a pretty good story in terms of the 3rd phase drill program that we want to put together, or that we have put together, and that we want to now go out and do at La Higuera. And hopefully with some positive results at Chiricuto, there'll be some good news there as well, in terms of follow-up drilling that we can raise capital for, to do further work at Chiricuto. But too early to tell. But that's sort of where we are, and how we think about fundraising and accessing capital. But I guess, yeah, very fortunate in that we do have some really supportive shareholders, who have been with us since the listing, since before the listing. So,
well, as a professional armchair Monday morning capital raiser myself, I did heavily dislike warrants. I've never raised capital, so I don't necessarily understand how hard really it is to raise capital without warrants. But I heavily dislike warrants. Even when I'm getting them, it doesn't really matter to me. I think they really are oftentimes a drag on the stock price, unless it's an exceptional situation where you have an exceptional discovery, which is, I guess, what a lot of people out there are kind of hoping for, or basing their entire bet on, which is not necessarily the best strategy. From the perspective of the mix, though, Tom, 46% is currently owned by retail, which is also reflected in the volume of the stock, which is to say there isn't all that much volume in the stock. Do you want to change that? Do you have a target percentage of the stock being held by retail, or how do you see that?
yeah, I mean, I think our objective is to grow the number of shareholders. So that's what we want to do. We have probably between 500 and 600 shareholders at the moment, which is, for public companies, not a lot. So one way we think about it is, we want to increase that number each year that we're in business, and with an increased number of shareholders, you would expect increased liquidity, right? Because people are coming in. So that's the overall goal. But we don't want to do that just for the sake of it, right? We want to do that in a way where we're growing as a business and bringing people in because we're having good news. There's no point having liquidity for the sake of liquidity. There needs to be kind of the logic there. So yes, is the short answer. We do want to improve the liquidity, but it is what it is. And some people often, well, not some people, but just some people will say, you guys are almost like a private company, with a public listing. And I think the other comment to make there is that, in an ideal world, we would just be doing this privately, right? Given where the markets have been since we listed those 27 months ago, you could argue that it hasn't really been worth being public, right? Because the markets have been, with a couple of exceptions where short windows where there was funding available, the markets have not been great. Let's be honest. But I think the counter to that as well is that had we not been public, those supportive investors that we've brought in probably wouldn't have invested. So you can't kind of have it both ways, I don't think. So we're happy with the listing. We want to grow the shareholder base. We want to improve liquidity, and hopefully that comes with positive results from our two projects, potentially bringing in further projects, and an appreciation in the overall share price and the market cap of the company as a result.
Is the plan or the idea, and do you guys have the ability to keep participating as insiders into every financing? And again, I'm not saying you necessarily have to, because I also understand that it can be tough. But is that the intention?
The intention is not to participate pro rata. We don't, neither Paul nor I have the capacity to do that. But as we talked about earlier, if we see opportunities, be that in the open market when we're not under restriction, or through private placements, to go in and acquire shares that we think are good value and with meaningful upside, then we will do that as and when we're able to. Yes, definitely.
How or where do you go looking for those more investors, though? I mean, what's the marketing plan, essentially, I guess, is what I'm asking. I suppose it's going to be some sort of a mix of conferences and digital and everything else, but what do you do?
Yeah, absolutely. I mean, I think we've, with the probably 60 or so people that we've brought into the last 3 rounds that we've done effectively ourselves, right? For each of those people, there were probably 3 or 4 others that we spoke to that didn't invest for different reasons. So we've got a pretty good network of people who we've been talking to for best part of 3 years since pre-listing. And we keep those, it won't be a surprise to you that we keep those people informed. And some are probably never going to invest, but some quite possibly will. So, and that includes to some extent some institutions as well that are following our story. We've also got some of the producers, like off the back of that first drill hole we did at La Higuera, where we drilled close to 300 meters at 0.66. It won't be a surprise for you to hear that we got quite a bit of inbound interest from producers, mostly copper producers, but even some gold names as well. And we've made a pretty conscious effort to effectively, I guess, bring all of those producers along on our discovery journey. So there may come a time where one of those bites and says, look, we really like where you guys are heading. We've been following you for 2 or 3 years now. Can we come in on the next private placement? So that's certainly something that, we're working towards. And then in terms of retail, the brokers I mentioned before, I mean, that will be probably the most likely way that we broaden the retail. There just isn't, our sense, there just isn't that much retail out there at the moment in terms of appetite and demand. So it's not an easy thing to do in this market, is our sense in terms of broadening the retail shareholder base.
How did you and I get in touch initially? I think it was a couple of months ago. I should remember this.
We reached out to you. We'd seen a lot of your videos,
okay.
Going back, I guess, 12 months or plus, and we got in touch just before Christmas.
Well, I'm sorry to hear that you had to sit through some of these videos. I know they can be painful, or most of them. How much money are you budgeting for marketing this year? What's kind of the split, absolute or relative amounts, whatever you prefer?
Yeah, I mean it's pretty limited and it's pretty ad hoc. I mean, we'll always go to PDAC, and then we'll go to 2 to 4 other conferences. We tend to divide and conquer, so that is the, I guess, fortunate part of there being 2 of us. We both live in I guess, mining jurisdictions or mining investment jurisdictions. I'm based in London, Paul's based in Brisbane. So, he can get up to Noosa for some of those conferences. I can get to Mines and Money and the Mining Journal conference. So, we whenever there's a conference nearby that doesn't involve a whole bunch of expensive travel, we'll go to those. In terms of marketing budget, we really haven't kind of, or we have avoided, I think it's a better way to put it, we've avoided blowing our brains out on kind of digital advertising and all that sort of stuff. We kind of do all our own social media, and just try to get the word out organically. Really very much of a boot leather approach. We'll go to Toronto and Vancouver kind of on a quarterly to 6 monthly basis outside of conference season, because we find that that's actually in many ways a better time to make meaningful connections. Going around Bay Street and going around Vancouver when it's not VRIC and not PDAC, we find incredibly useful, both in terms of meeting brokers, but also family offices and other investors, and we've had some success there in terms of bringing people into our latest financing. So it's very low budget, but also in some ways budget constrained, right? Because we think we could do a lot by putting in the time. And quite often we'll be presented with marketing opportunities where there's no clear way of measuring the effectiveness of the money you spend there, and we're very hesitant in those scenarios. Not to mention getting signed up to multiple month agreements where you're basically signing up before you see what you get. So yeah, we're pretty hesitant. And I think that sort of shows in that we touched on G&A earlier. That sort of shows. I mean, I think since we've listed, over 60% of the cash that's gone out the door, so excluding share-based compensation, over 60% of that has gone into exploration activities. And then, as you mentioned, the remaining 40%, approximately half compensation, half G&A. Obviously, that's also a factor of how much do we raise. So the more we raise, the higher that percentage is going to be, because our G&A is not necessarily going to go up much. Unless we ramp up the marketing budget. But we're only going to do that when we see a market where, we think those marketing dollars are going to be well spent, and that we're going to, convert effectively people to becoming shareholders.
What I mentioned at the beginning is around $60,000 that you're spending on average on G&A as a whole. Marketing was only about 9% of that. You say it's not going to go up much. Is there a target G&A that you have for 2025? How much money do you think you're going to be spending?
Yeah, we're trying really hard, and this is sort of, I guess, channeling the old Xstrata spirit, right? People used to say Xstrata was lean and mean.
Sure.
You know, Xstrata used to run. There was a split head office, but there were, when I joined 20 years ago now, a bit more, there were 11 people in the London office running Xstrata. Granted, it was a smaller company back in late 2003, but it was very much lean overhead structures, small teams, and we're channeling some of that spirit and really trying to keep Paul and I, you've got the whole team on the call here today, right? We're the only two employees, albeit the way it's set up is we're consultants to the company, but in full-time capacity as CEO and president, and everybody else that we work with is either a consultant or a contractor, in some cases on very modest kind of retainers. So we really try really hard because we know that if we're going to have longevity and we're going to keep bringing those projects in and keep working them up. And I think for a junior that's been listed for just over 2 years, the fact that we're on our third drill program already, I think is certainly above average if you look at the universe of peer companies out there. And one of the reasons we've been able to do that is because of that money we've raised, only 800,000 Canadian per year has gone into G&A, and the rest is going into the ground. So to answer your question, we want to keep as close to 800,000 as possible for this year as well.
What is the well, you mentioned that you guys are the only two employees. What's the compensation package based on here? Essentially, what I'm asking for here is KPIs. Is it attached to the share price? Is it attached to exploration success? And I'm talking total compensation here, so cash component with, and then share-based compensation as well.
Yeah. So the total compensation for the team is, well, I'll break it down. So Paul and I each get 150,000 Canadian dollars per year in cash compensation. We have a part-time CFO who's on 40,000 Canadian a year, and then our two directors each get 30,000 Canadian. And then there are cash per year board fee, and then there are equity components on top of that. So options for management and DSUs for the directors. And the board reviews each year based on exploration success. It's, as you would imagine, somewhat subjective, especially given the stage that we're at. And then based on the benchmarking of peers, the equity component of that. I think it's important to say, Paul and I already own a significant piece of equity, as we've talked about in the company. So, it's important that, management are, continue to be incentivized by the possibility of creating further upside. And that's what the options that management receive are designed to do. And that really, what that does is align us with our shareholders, right? And I know that's a bit cliche, but it genuinely does achieve that.
So it's kind of a basket of other companies that you compare it to, and then you look at what kind of their KPIs are, or what is it?
We actually haven't gotten into that level of granularity. As we become a bigger company, we'll be looking to bring in some of those more rigid approaches that you see. You see people going out and hiring external consultants and paying them a whole bunch of money to come up with all these sorts of things. And we've not gone down that route yet. Again, kind of the lean and mean, but we've got some pretty seasoned independent directors in there who kind of have seen a lot of these companies over the years and are comfortable with and are guiding the company to make sure that the compensation structure is aligned with industry norms and most importantly, serves the interests of the non-management shareholders, right? Which is ultimately their job as independent directors, is to look out for those other, whatever it is, 548 shareholders.
What I'm really after when I ask these questions, Tom, is trying to figure out how you think or how you treat your own paper, essentially, and whether you're going to be using your options and your shares to make large payments, essentially. Because it's one thing we talk about financing and when and how and what, and I think we've touched upon it well in this conversation. But a lot of companies would then also turn around and pay a lot of the marketing providers with equity in one way or another, or they would use equity to, again, compensate directors and so on and so forth. So that's really where I'm coming from. How do you think about that? I mean, is using your shares as a method of payment something that you would do, or is it something that you typically do not like doing?
It's something that we typically do not like doing. We've made one exception where a service provider came in, and we might as well be transparent here. It was Verify, and so we did an equity swap with them to try that service out. We took the view that they brought more than just being the service provider. They've obviously got a team and some people there who are very well connected in the industry. So we took the view that, having them as shareholders, potentially telling a few of their friends about us was no bad thing. So we saw some additional value in that, and that's why we made that exception. But typically, we would not go out, and we've certainly, I mean, thinking back to when we were building our website, there were people who came in and, wanted to receive shares for putting a website together for us, and we immediately shut that conversation down. So yeah, in general, we're pretty guarded about handing out equity to service providers. Equity gets handed out with the goal of making sure that the team's interests are aligned with interests of broader shareholders, and that's it.
I saw that you did and you have your Verify easily available on your website, which I actually do appreciate. You kind of have the virtual site tour a package or whatever it might have been that you got from them, which I like. And I'm happy that you're actually using it. I see too many companies, paying very, and it's not cheap. It's not the most expensive service out there, but it's not the cheapest either. And so, as a shareholder, potential shareholder, I would like to see that actually being utilized. I'd want you to take out every last drop of benefit from it, or potential benefit from it. So I like that you actually have it up on the website like that. I want to go back and we might start working toward wrapping it up. I think we've been at it for about an hour and a half or so. So I don't want to, Paul, take your entire evening over there in the land down under, and I'm sure, Tom, you would like to go and have lunch soon. But to go back to how you're going to finance this thing, what about a JV? We haven't talked about that yet. Is it too early to go out there and explore either a strategic asset level or an equity level investment?
No, I don't think it is too early. And again, we mentioned that we're bringing those producers along on the discovery journey, and part of the reason for doing that is absolutely to have the possibility of bringing someone in at the project level. Again, I think that's another advantage of being a company that's running a portfolio of multiple projects, is that you're not afraid of JVing one of them. Again, coming back to my earlier point about management teams being entrenched, if you only have one project and you JV it or farm it out to someone, then what are you going to do as management team, right? So absolutely, and we're going to be pretty pragmatic here. Ultimately, whether we sell projects, JV projects, sell the company, we're just going to be driven by what our shareholders want to do and what we as shareholders ourselves want to do in terms of getting a return on the investment at the time. I think in terms of JVs at the moment, we don't know what we're going to get with Chiricuto, but just based on location and neighbors, obviously that sits in that Manto Verde Santo Domingo district that's dominated by Capstone Copper. So might there be an opportunity down the road with them or with one of the other juniors operating in that district potentially? But yeah, that's definitely something that we would look at. Working with those majors can either be a private placement at the company level, or it can be some sort of JV arrangement. And then you have as well, which we spent a bit of time thinking about, you have producers that are not currently in Chile, don't have boots on the ground, that see what we're doing. And we've had one come to us and say, is there some way we could work together, channel your Chilean current portfolio, but also your broader experience and connections in Chile to potentially go hunting for new projects together. So we look at those sorts of opportunities as well. So yeah, long answer, but yeah, absolutely, JVs is something that we would consider.
What would that look like? And this is kind of a key component of every junior, right? And it's important for me to see how you guys think about it. But how much of the upside are you willing to give away? Because a major or mid-tier, whatever it might be, that enters, they want it all. They're responsible for their own shareholders. So they want to take 75% of the upside, as an earn-in option agreement or something like that. What are you prepared to do? What do you envision? What do you hope for? And those are words that should remind people that this is all forward-looking that we're talking about. But what's in your brain right now?
I mean, it's difficult, right? Because there's going to be that natural tension of any negotiation where you're going to have to come to some sort of compromise, right? And they're going to want to take it all. I guess, being in a position where we've got a clear understanding of what we think something is worth, and we've got a clear understanding of obviously what we've spent and the kinds of returns our investors are going to be expecting on the dollars that they've put in. And, they're not here for a 2 or 3 times ROI, right? People are here to make 10 times plus, right? So, we're gonna have those numbers very much in mind when we look at bringing people in and the terms on which we would do that. And then the other thing as well that's going to determine it is, what's the next logical phase of work, right? And how would we finance that? And what's our cost of capital going to be, relative to bringing in a major who's going to take it off our hands from a financing obligation perspective and move it forward? And what's the time value of money, right? Can they move it forward quicker because they don't have to sort of live with this sort of hand-to-mouth existence that a typical junior mining company does, where it's, drill fund, drill fund, drill fund. So, all of those factors would get weighed up, and, we would negotiate as hard as we could and see if we can come up with something that we think our shareholders would be happy with.
Gentlemen, let's start working toward wrapping it up. I'm hoping we're going to have future conversations once you have some assays out, or maybe even before that. I really appreciate you investing so much time. I mean, I think I've gone through most of the important questions here. What am I forgetting to ask you, though? What did you come here hoping to talk about that I failed to bring up?
If I can go first, and then Paul might have something as well. I'm not sure, but I think one thing we didn't really touch on was the underlying option agreement at Chiricuto and the same at La Higuera. I don't think we want to go, as we're trying to wrap up, into a lot of detail on that, but I did just want to make a couple of points, and people can read about the details in our various news releases and it's in our presentation as well. But I think one thing that we've done, which is a little bit unique, and it was partly born out of necessity when Paul and I were funding the company privately, is we've come up with what we think is a unique concept. At least that's several people have told us they've not seen it before, which is this concept of during the option period, using instead of what is typical in Chile, which is 6 monthly payments of pre-agreed fixed dollar amounts. We've come up with something called the exploration levy, sobre tasa de exploración, they call it in Spanish. And what that is basically, because the underlying owners in Chile are used to these regular payments, it's almost like they clip in a coupon when they option out their properties. And a lot of these are speculators that don't know much about mining, but they've all got a friend who sold a property for 10 to 30 million to a cashed up Canadian junior. And they want these regular payments. And so what we've said is, look, at the time, we're a small private company. We can't commit to these because we might not be able to raise the money. And we might be 3 years into a 5-year option and we can't raise the money for the 36-month payment, and then we're going to lose everything. So what we said is, look, for every dollar we spend exploring on your ground during the option period, we'll tot that all up at the end of the year, and then we'll pay you a 5-cent surcharge. So we pay a 5% exploration levy. And we came up with that for La Higuera originally, for the Gaby property, and we've applied that at Chiricuto as well. And we find it's a good compromise, between what the local speculators and property owners are used to, and what we as a junior company can do to protect our shareholders effectively from losing the properties. Because you see too many, and I'm not going to list them out, but there are too many Canadian juniors that go into projects and never get to the final year. And oftentimes not because, of drilling and not finding, what they're hoping to find, because the markets turn, they can't raise the money, and an option payment comes up and they're unable to make it and lose the property, and it reverts to the original owner. So I think that's something that was just worth highlighting. And it's an example of, us being kind of entrepreneurial and it's not just the cutting edge science in terms of what Paul brings with his Australian mindset, but it's also on the business side. Paul, did you want to add anything else to what has Antonio forgotten to ask us about question?
Yeah, I guess there's one thing I would make a comment about, and that's the general exploration environment in Chile. And we discussed the permitting, and it's fantastic. At least our experience has been fantastic. But the Chilean system is in a state of flux at the moment. Back just before COVID, there were some riots, etc., in Chile, and there was a lot of there was a constitutional convention, etc., and there was a lot of media commentary in North America about nationalizing the mines and all this sort of stuff. All of which you know was not a worry. But what has happened in the last year or two is the government have said, well, what we want to do, and I'm not sure what their motive is to make property license payments has increased dramatically, and so they have increased fourfold the license costs. So that what I mentioned earlier with Chile being very tightly held from an exploration sense is actually starting to change now, because a lot of those speculators are looking at having to pay 4 times more per hectare. So it's now $28 per hectare. So, for example, our license fees are over 100,000 US now annually. So that what's happening is in Chile, there's a lot of property being dropped, vended, farmed out, and becoming available. And so this increase in license fees is a double-edged sword. Obviously, we're paying more, but we see it as an opportunity because we're now getting so many people coming out of the woodwork with projects that were hidden away before, purely because they're concerned about how they're going to manage those increased fees. So you know, it's a very dynamic place in terms of junior exploration environment in Chile at the moment, which we see as an opportunity.
And to some extent, we're you know in a relatively good position there, because we've always taken, partly again born out of necessity in the early days when we were self-funding the business, but we've taken this sort of quality over quantity approach. So that hit, whilst our license fees, round numbers, are going from 25,000 US a year to 100,000 a year, you know, we've got relatively small exploration packages that to pay those license fees on, versus, you know, other juniors out there with much bigger concession packages. So, you know, the hit to us is relatively less. So, you know, we're in a relatively fortunate position there.
Well, thank you, gentlemen, and thank you, Tom. Indeed, that was a point on my question list, but I did feel to bring it up. So thank you for doing my job for me. I can use some help, as you can see, so that it's much appreciated. And yeah, thank you so much for sitting down with me. Hopefully we can catch up sometime in Q2 of this year when you think you're going to have the assays out. So yeah, I'm looking forward to it. And thank you so much for sitting down with me today.
Thanks,
Yeah, well,
Antonio.
thank you for your time, Antonio. It's great. Thank you.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company-specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias, again, albeit clear or not. So always ask yourself what the incentive of your counterparty is, and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should, under no circumstances, be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Also, unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."